No, this is not a video where I disclose the highest dividend yield companies. Hey everyone, John here, not an analyst. Welcome back to the channel. Dividend stocks can provide investors with predictable income and long-term growth potential. However, not all dividend stocks are great investments, and many investors aren't sure how to start their search. No worries, I've done all the dirty work just for you. So all I ask in return is just smashing the like and subscribe button so that I know you love to watch more contents like this in the future. After spending hours of research and screening through hundreds of companies from different sites, not that one, finally I was able to shortlist 10 companies that have been distributing dividends consistently for the past 10 years, even during times of a market crash. Some of the metrics we used to analyze these companies are their 10 years historical dividend payout, net earnings, retained earnings, and free cash flow. Why only 4 metrics, you may be asking? Well, generally dividends are paid from there. With that in mind, here are the top 10 consistent dividend paying stocks. Coming up in the first list, we have Nestle Malaysia Berhad, ticker symbol Nestle, with dividend yield dropping from 3.2% to 1.7%. Now, you may be thinking this is bad because the yield dropped almost half compared to 10 years ago. But of course, there are its valid reasons. For those who don't know, Nestle grew more than triple in share price, and if you know dividend yield's formula, the denominator of dividend yield is the company's share price. Hence, when the share price grows faster than the dividend per share, it will result a lower yield. Now, that does not mean that Nestle is a bad dividend payer. In fact, their dividend payout has risen more than 60% over the years. Not only they have been consistently distributing their dividends, they have been increasing the amount as well. Not to mention, their share price had grown significantly. So if you held any Nestle shares since 2011, you will most certainly be a very happy investor, collecting dividends every single year while enjoying your massive capital gains. Though, one thing to note is that the company's retained earnings have been falling quite substantially. This either means they have been using their reserves to pay out the dividends, or maybe it is used for business expansion or maintenance. Then again, the fall in retained earnings can easily be offset by their free cash flow growth, as they have been making positive free cash flow every single year, some years even greater than the amount of dividend payout. That being said, Nestle is definitely one of the dividend stocks that you may want to put in your watch list. Up next, we have Leong Industries Berhad, ticker symbol HLIND, with dividend yield growing more than 2 times. Very impressive. Besides that, the company has been maintaining a healthy payout ratio on average 50% of its net income, aside from financial year end 2017 and 2020. What's even impressive about Leong Industries is how much retained earnings are sitting inside their balance sheet. Let's say they didn't make a single profit for the next 10 years. Yes, I'm over-exaggerating, but even with 10 years of not earning a single profit, the company still have the ability to distribute the exact same amount of dividends as they did for the past years. Wait, that doesn't make sense. What about the cost of day-to-day operation and business expansion? Great point you have there, which brings us to the next slide. As illustrated, the company has a very healthy free cash flow to dividend payout ratio, suggesting that even after spending the necessary expenses like working capital, maintenance and capital expenditures, they still have a lot of free cash flow on the side to play around, making them one of the best dividend payer on Bursa Malaysia, in my humble opinion. Next, we have Malaysian Pacific Industries Berhad, ticker symbol MPI, with a not so attractive dividend yield around 0.7%, but at least it is still growing slowly. Based on its net income to dividend payout, MPI has been improving a lot, reducing the spread from 80% payout ratio in financial year end 2013 to less than 30% starting from financial year end 2015 and beyond. Besides that, their balance sheet is stocked with large amount of retained earnings. To be specific, the dividend payout only represents less than 6% when comparing to its reserves. In addition to that, they have been growing their free cash flow substantially over the years. Definitely one of the best consistent dividend paying companies to put in your watch list. The fourth stock that we'll be looking at is Dotcom Berhad, ticker symbol Timecom. You will notice in financial year end 2011 to 2013, they didn't distribute any dividends, hence the 0% dividend yield. After that, they start to distribute dividends, but there's a sharp fall in dividend yield as the company declared a one-off special dividend in financial year end 2015. Assuming the company cancelled the special dividend distribution, it will be the same yield as financial year end 2014, sitting around 0.4% to 0.5%. You can see the pattern of dividend payout chart is similar to its yields. Personally, I believe payout will be even better in the next 5 to 10 years, with more high-rises built in urban areas, and not to mention their extremely sticky business model, offering the best quality and low-cost fiber optic network in Malaysia. You can also see their retained earnings are very healthy, with dividend to retained earnings ratio of less than 10% for the past 9 years. On top of that, free cash flow has been growing tremendously over the years, a strong turnaround from negative to generating positive and growing free cash flow since financial year end 2014. If you believe in Timecom's business and the future demand for their product and services, I would highly recommend you to put this in your watch list. Coming in number 5, we have Petronas Gas Berhad, ticker symbol PETGAS. I think this one will make most dividend investors drool over, with dividend yield rising as high as 8% in 2020. However, do keep in mind that their share price has also dropped about 36% since its peak of 24 ringgit and 50 cents per share in 2014, hence making the dividend yield seems very attractive. One notable aspect about PETGAS is they have been increasing their dividend payout by 30% over the past 10 years. Plus, they have been very consistent. The spike in dividend payout in financial year end 2019 to 2020 is due to the one-off special dividend. Without the special dividend, the payout amount would be similar as financial year end 2018. Nothing much to complain on its retained earnings. It's very healthy, sitting at 15% payout ratio on average. Although its free cash flow growth has been quite choppy over the years, it has been rising nonetheless. However, it's still something that you may want to pay attention in the future. Next, we have Lingkaran Transkota Holdings Berhad, ticker symbol LITRAK, another dividend stock to die for with yield over 6%. The company has a growing net income with a small growth in dividend payout. Nothing much to be concerned of as long as it stays consistent. However, it should be a red flag once dividend payout starts to decrease. Also, another impressive and healthy retained earnings to dividend ratio, improving from 30% to 15% over the years. I think this is a plus point for LITRAK with the immense growth in free cash flow year after year. Definitely something commendable. Number 7 on the list, we have Uchi Technologies Berhad, ticker symbol UchiTech. Inconsistent dividend yield, but it's not something you should be concerned of. What's important is how consistent they have been distributing dividends to their shareholders. Although the chart doesn't look as appealing as the previous dividend stocks, their payout is still growing nonetheless. However, one thing to take note is the sharp fall in retained earnings since financial year end 2016. Even so, its free cash flow has been healthy. There are more years growing more and in tandem with the dividend payout. Not the best, but most definitely not the worst either. I will keep an eye on them as their coffee machine business is quite interesting, especially once they successfully penetrate China's coffee consumption and grow their revenue as big as the Europe region. Certainly a company that you want to put in your watch list. Alright, we are close to the last one. Number 8 in the spot, we have Formosa Personic Industries Berhad, ticker symbol FPI. Potentially another favorite among the dividend investors, with yield growing as much as 3 times for the past 10 years, sitting at 5.58% at the moment. Although net income looks choppy, wait till you see its free cash flow. The company's retained earnings have been rising significantly for the past 10 years, sitting at less than 15% payout ratio in accordance to dividend paid. Okay, so here comes the free cash flow of FPI. Look at how the free cash flow is greater than the dividend payout at almost every single year, which shows a very strong and healthy growth. Just from its cash flow, they can easily distribute the dividends and it's growing faster since financial year end 2018. Definitely deserve to be in the top 10 list. Next up, we have Panasonic Manufacturing Malaysia Berhad, ticker symbol PANAMY. Another bumpy historical dividend yield due to its inconsistent payout amount, which I will show you in the next slide. You can see their payout is all around the place. However, the overall amount increased heavily starting from financial year end 2018. Not to mention, the company has a very sticky business model and strong brand name that has been around for 56 years. No problem with their retained earnings, very reserve rich, sitting at less than 14% dividend to retained earnings ratio. Likewise for its free cash flow, although I would prefer the free cash flow to be above the dividend payout, nevertheless it's still alright considering their cash flow has always been in the positive, plus there are certain years more than the payout. And last on the list, we have Open System Malaysia Berhad, ticker symbol OpenSys. This is another classic example when investors solely look at high dividend yield companies. So, is it bad when yields drop more than 80%? Let's look further into it, shall we? Looking at its dividend payout, it has grew about 80% over the years. Very good, with payout ratio to net income maintaining at 50% on average. In addition to that, the company has a very rich reserves, reducing the payout ratio from 50% to as low as 10% in 2020. Furthermore, their free cash flow has been on a positive and greater than their dividend payout, aside from financial year end 2014. So back to the question again, why did the dividend yield drop so much? If it based on its historical share price, it had increased more than 800%, which is why their dividend yield dropped so much. Isn't it the best thing when you have both dividend payout and share price grow so much in tandem? So you see what I'm trying to say? So those are my top 10 consistent dividend paying stocks in Bursa Malaysia. What a great way to end the video with Open System as our last stock on the list, explaining why investors should not solely rely on dividend yield when justifying it's a great dividend stock. Then again, you need to remember this, present and past performance may not represent the future. I had mentioned this in my previous video on the top 4 myths of stock investing. You can check it, I'll put the link in the description or somewhere in this video. That being said, it's more important to understand their business to determine its potential future earnings and if the dividend payout is sustainable. That's all I have to share in this video. Hope you guys enjoyed this massive value packed video. If you did, I appreciate it if you smash the like and subscribe button to support more future contents like this. I'm utterly grateful if you can help me with that as a form of appreciation for my work. Also, comment down if you have any questions. I'll be happy to get back to you. With that, I'll see you on the next one.